Hello guys, welcome to my YouTube channel and I hope you guys are doing well. Today I'm going to discuss a very important topic about how you can build a portfolio that you can hold forever. You don't sell anything, you just hold it forever and grow that account. If you are interested in that, then please stick around. We are going to discuss all about that. Okay, part one is the type of account. So you can have primarily two types of account. The first is a actively traded account and the second is a long-term account. And I believe that everyone should have in their investing portfolio these two types of accounts separately managed. Let's discuss the actively traded account first. So this is the account that you can hold the stocks which you actively trade on. You can do a swing trading on that, or if you want to do a day trading, you can do inside that, or if you want to do options trading, because options trading are mostly a short term or a swing kind of trading. So you can do all the option trading, swing trading, or day trading in that account. But do not hold any securities that you want to hold long term in that account. Now the second type of account which we are going to focus today is the long-term account. This is the account that you kind of set and forget kind of account in which you primarily hold stocks or ETF or index funds that you do not plan to sell for as long as possible, right? So that is what we are going to primarily discuss, and this is a type of account that everyone should have, and it should be separate from your actively traded account. Why is it so? That is very important because if you look at your actively traded account, right, you may come under emotion, or if you see that account going down, you might be tempted to sell, or if you see on the other side, if you see a very huge profit, you might be tempted to sell early, and then it might go up another 10% or 20%. Emotion would play into you and you would be tempted to buy and sell kind of within that account, which because historically if you look at the market, right, especially the US market, right, S&P 500 or the Nasdaq 100, right, so if you look at their graph, they are kind of exponential graph. There may be a downturn in between, but if you kind of zoom out of that and then look at that graph, you would see a exponential growing graph, right? So what does that tell you? Let's say someone had invested in S&P 500 10 years back, right? They have definitely made a lot of money in that, right? Or they may be still holding. If they hold for another 10 years, it's a guarantee that they will make money on that. On the other hand, if you try to do a swing trade, you may be profitable in the short term, but on a long term, it is kind of you have to be really consistent. You have to have the emotion out of it. But most people cannot do that. That's why it's always a good idea to have a separate account to maintain your long term portfolio. Okay, so now let's discuss how you should build that portfolio. That is our main focus for this particular video. So there are a couple of things that you should keep in mind. The first thing is it's a good idea to always have index funds or kind of a ETFs in your long-term portfolio. Holding a stock may not be a good idea unless you have like 100% conviction on that stock that it will not go down. Like you may hold like a stock something like Apple, right? So over the time, if you look at the graph for Apple, it is a pretty nice looking graph, right? So those kind of companies you can hold it, but my recommendation would be you just hold a certain index funds and let it be there. Now within the index fund, it has to be a right mix. In this mix, the main thing is I would like to divide this in four parts. The first part is the major portion of your portfolio, which I would dedicate like 60 to 70%, and that you can put like a US domestic broad index fund, right? And the second portion, which you can allocate 20 to 30% on the international market. You should always have a exposure to the outside US as well, in case you see a downturn in a US market, but let's say emerging markets are doing better, you're kind of balanced from that angle as well. So definitely put like 20 to 30% in the international market. Now the third is the real estate sector, right? Now, real estate, another sector that is kind of a very large sector, and we should have some exposure to this as well. So, I would say you can put like between to 10 to 20% in the real estate sector. Now, the last one is the bond, right? So, whatever is left, like 5 to 10%, you should have put it in the bond. So, now, this is the kind of mix that I would recommend for anyone who has a lot of years left in their investing journey. If you are close to your retirement, then this mix may not work well for you. So, this is mainly for someone who has 10 to 20 years left, or maybe more than that left in the investing journey for them, right? If you have liked the video so far, I would really appreciate if you can like the video and subscribe it. That helps a lot. Okay, now going back to the topic. Okay, the final part is the actual portfolio that I also have and what you can do as well using a Fidelity index funds. The first one that I have in my portfolio as well is the Fidelity Total Market Index Fund, and this is the fund that kind of captures the whole of US market. So you can put let's say 60% on this index fund. The second one is the Fidelity International Market Index Fund. In this one, you can put 30% of your portfolio. The third one is the Real Estate Fund. This is again from Fidelity, which is called a Fidelity Real Estate Index Fund. You can allocate 20% there. And the final are the bonds. So you can allocate, let's say 10%, divide it like 5% between the Fidelity Inflation Protected Bond Index Fund and Fidelity Treasury Bond Index Fund. So you can divide the final portion between these two funds. So that builds a right kind of mix for you, allocating between covering all the aspects that we discussed in the part 2. It covers the total US market, it covers the total international market, real estate and bond as well. So this is a pretty good mix that you can have in a long-term portfolio. There are few more things that I want to discuss here. The first thing is you have to have a regular systematic investment in this portfolio. So you can have like whatever amount you can put every month, right? Or every week or every month, you should put on this account. And no matter the price, you should not look at the price, just keep investing on this and let the compounding takes its own course, right? So you should not look at this portfolio every day, just keep investing into it. Okay, the final point is where you should build this account. So you should ideally build this kind of account to something like a Roth IRA, which is a pretty good account to have this portfolio. This is a tax free, right? So once you get retired, you're going to get all these whatever accumulated wealth that you're going to have, all that would be tax free, right? So that's a major advantage of that. You can use any other regular account as well, but Roth IRA would be preferred. Okay, I've shown this in Fidelity. However, you can build a similar kind of account using other index funds from Vanguard as well. So just take it as a template. Even Vanguard has one-to-one if you match, right? Like in case of Fidelity Total Market, you will find a Vanguard Total Stock Market Index Fund as well. So similar to Fidelity, Vanguard or even Charles Schwab has a same kind of index fund. So it works for any other brokerage firm if you are already into them. So that was it guys for this video, and I hope you have liked the video. If you did, then please press that subscribe button, hit that bell icon so you know when my next videos are coming. And if you have any further question around this or anything around investing, especially the options kind of investing, then please put your question down in the comment section. I do look at all the comments and try to respond as soon as I can. Happy investing guys, and I'll talk to you in my next video. Bye bye.